Welcome to my video series that I'm starting calling Chalking It Up on the Dry Erase Board. So I know in my personal life, I've got whiteboards everywhere. I've got them in my kitchen, my office, my basement, my bedroom. They're everywhere. Okay. So I am a very visual learner, and I think a lot of other folks are too. The Chinese philosopher Confucius once said, I hear and I forget, I see and I remember, I do and I understand. So, by us doing this on the whiteboard, hopefully this helps. I know it helps me. So, what we're talking about today are top 3 things you need to get approved. When we talk about getting approved for a mortgage, whether you're a first time home buyer, seasoned buyer, foreign national, it doesn't matter. It really comes down to these 3 core fundamental factors. Okay. Number 1, credit. Number 2, income. Number 3, assets. You can have 2 out of the 3 and be just fine. If you have 1 out of the 3, good chance you're in trouble. But we can get creative. So let's talk about this. Credit score. FHA, we can go down to 500, VA, 580, conventional, 620, and we have options for a no score. So this gives you a wide variety of what we can offer and really what your score needs to be to get approved. Now, I had a file recently, a couple months back, where borrower 1 had a fine credit score, but didn't have enough income to support the mortgage. So we had to go ahead and add a cosigner. Now, the cosigner had income and plenty of assets, but had paid their mortgage off, auto loans, installments, had no credit cards. So when I pulled the credit score through, it came in at 0. In that scenario, most banks and credit unions would turn that file down and decline it. Not here at Lending House, because we have over 50 different wholesalers that we go to market and shop out for you as the consumer, the best pricing and the best loan product for you. So in this scenario, we had a no score, right? So we went with an FHA manual underwrite. Now, what does an FHA manual underwrite entail? Well, you need 10% down. In this case, they were putting way more than 10% down. So we were good there. And you need compensating factors. Okay, what are compensating factors? They are assets, reserves, they are additional income, investment income. It can be a multitude of things, right? So in this scenario, we had the compensating factors and we had the non traditional credit history, the trade lines, whether that be insurance, phone bills, any other payment that you've had for the past 12 months that we can document essentially. So we were able to get that file approved and funded. Now let's dive into income. Income's probably the most important, if not the second most important, on top of credit when it comes to getting approved for a mortgage. So when we talk about income, we have W-2, self-employment, 1099, retirement, and when you talk about the W-2, you get into bonus and commission. So let's break all this down, right? With W-2 income, it's fairly easy to calculate. You get the W-2, we use that, we get your year-end pay stubs to calculate commission, bonus, overtime. Now, FHA is going to at least need a 12-month history to use all of your commission and overtime. Conventional is typically 2 years. Now, there are some exceptions with certain lenders, banks, and credit unions, but that's typically what it is. Now, with self-employment, okay, this is where it can get really tricky. If you are a true American, and I do this myself with my mortgage business, is at the end of the year, I find as many write-offs as possible so I'm not paying Uncle Sam a bunch of money. Well, when you do this, what happens is on your tax return, your Schedule C, your profit and loss, is going to show a much lower number than what you actually made. So when you go to apply for a mortgage and you send me your tax returns, I'm going to look at that Schedule C number and it's not going to be enough to get approved. Now, what do we do in that scenario? Well, we look at our non-QM space, so non-qualified mortgages. That's going to be bank statement loans, 1099 loans. We have 1-year tax returns, P&L, profit and loss. So we have creative ways to get deals done. Now, the picture that I have to paint in your mind is when we step into the non-QM space, every other lender has told you no. We have an option to tell you yes, but hold on, because pricing and costs are going to be higher. If I'm pricing today on a conventional product 20% down at 6.25, on that non-QM product, it's going to be at least a whole percent, if not 2%, sometimes 3% higher, depending on your down payment. So just be prepared for that, but it still gets you into the home so you can start earning appreciation immediately. Number 3 is assets. So assets can be your savings, checking, 401k, money market, CDs, any liquid accounts that you have. A lot of folks are not aware that you can pull from your 401k and take a loan out against it to buy your home. And you're not penalized with taxes and you pay it back to yourself. So that can be a great tool. So going back and tying this all together, the top 3 things that you need to get approved. Number 1, credit score. Number 2, income. Number 3, assets. Hope this helps and stay tuned for many more videos.